If you have money in a savings account right now, you're losing money to inflation. But here's the thing. There's a historical investment that returns 10% per year that you could start today. I'm talking about ETFs. And today I'm going to show you how to use them to build serious wealth, even if you've never invested before. Hi, I'm Brendan, and I've spent the last 6 years educating young professionals like yourself how to build wealth. And the number one tool I recommend is ETFs. By the end of this video, you're going to know exactly what an ETF is, how to buy your first one, and I'll give you a simple 3 ETF portfolio that you could copy today. So when you think about ETFs, I want to show you a graphic on the screen that's going to make a lot more sense. As you can see on the screen, there are investors that pool their money together, they put it in a pot, they give it to a fund manager, some smart guy in a suit, and he goes to purchase a group of stocks. And because it's an ETF, and because I like passively managed ETFs, which we'll get to in a second with actively managed ETFs, this fund manager basically just invests your money and then leaves and doesn't really manage much. And that's typically why there's minimal cost with ETFs. And a real world example I'll share with you today is VTI. As you see on the screen, VTI is the Vanguard Total Stock Market Index. And if you look at the product summary of this is seeking to track the performance of the CRSP US Total Stock Market Index. This is comprised of large, mid, and small cap equity diversified across value and growth. If you look at the style box here, you will see that there are different sizes of companies. Typically, small cap and below are $2 billion market cap or below. Mid cap is 2 to 10 billion, and large cap is 10 billion or above. The way you calculate market cap, you don't really need to know. You just generally need to know this, that's the size of the company in relation to the market, but it would be the total share price times the total outstanding shares if you want to get to the actual valuation. As far as value and growth, and a mix of growth and value is what you see in typical and traditional ETFs, where you have high flyer growing companies like a Tesla that's growing very rapidly. They have a very high price to earnings ratio, meaning a lot of people are betting money on them to grow at a fast rate. They're probably not offering a dividend. They're probably not a very mature company. Whereas a value-based company might be somebody that's been around for a long time. They have a great value to the market with their price at, and they might offer a dividend, and they're probably a little more mature. That is the difference between those. The cool thing about this employs a passively managed style, which is awesome because like I said earlier, if it's actively managed, there'll be a higher cost to this. And when you look at the actual cost of this fund, it is 3 basis points or 0.03%. And if you look at the composition of this fund, there are 3,500 plus stocks in this. They are distributed between 11 different sectors of the stock market. And most of the big names that you know are Microsoft, Nvidia, Apple, Amazon, Facebook, or Meta, as you know, AVGO, which is Broadcom, Google, Tesla, Berkshire Hathaway, and Google, which is Class A and Class C shares. And most of the companies within this, you know, and you're very well aware. Now, there's obviously a lot more. You can open the entire composition if you want to see those. But the reality is this is a competing fund to where the best stocks will rise to the top and the worst stocks will fall out of this, but we don't have to guess in specific companies. And that's exactly why they're perfect for beginners, because you don't have to be a stock market genius. And even if you are a stock market genius and you know how to read a 10K and fundamentals and technicals, you're probably going to guess wrong most of the time. And that's based on a lot of data and statistics that I talk about all the time. Here's why we use ETFs versus everything else. The first thing is individual stocks. The average investor over the last 20 years returned 3.6%. That is just pacing inflation. Whereas the S&P 500, which is a passively managed ETF like VOO, has returned 9.5%. Now, why are ETFs better than mutual funds? Over the past 20 years, only 5% of actively managed mutual funds have beat the S&P 500, which is a passively managed ETF like VOO. I like data, and so I'm not going to guess which 5% those are going to be in the beginning of that 20-year period because I'm likely going to be wrong. Why are ETFs better than savings accounts? Because we're comparing apples to oranges. You shouldn't be saving your money ever unless it's an emergency fund or a sinking fund for a particular thing coming up. And all of your money should be going into passive investments like ETFs. If you're putting your money in cash or a savings account, you're losing money to inflation straight up. So you're guaranteeing a loss by putting your money in savings, whereas you can put your money in an ETF that will have volatility, but also have better returns long-term. So I'm gonna walk you through a live demo of how to actually go open this right this second. So the first thing you wanna do is go to Vanguard.com and click on Personal Investors. When you're in Personal Investors, you go to the top left-hand corner and you click on Product and Services and you go under to Accounts and Plans. Now, which account you're gonna select the ETF within is up to you. I like to use a Roth IRA, which is a good retirement account, or a taxable brokerage, which is a very flexible type of account. Whichever one you use, open that account first Then we'll select the ETFs within. So let's say you open a Roth IRA. The second thing you want to do is figure out which investment product to pick within. Now, we talked about a 3-fund strategy that you could use to your benefit, but let me just show you how to actually filter on these different ETFs. So within Vanguard as well, you want to go to investment products and click on ETFs. Then below, you want to click on view all Vanguard ETFs, and you see that there's 97 types. Now, we talked about some filtering of this right already. We want to do an ETF, not a mutual fund. Our strategy, we could do a total market ETF. That's always a good starting point. And then what we could do is our management style would be index, not active, because over the last 20 years, only 5% of actively managed mutual funds have beat the S&P 500. Not worth it to guess on that. Our asset style can be stocks if that's what we're looking for. And then we can select large, mid, or small. Typically, large is the least risky to begin with. And you can select a blend of value and growth. And then the last piece of this would be to select the US, which is a great starting point. And as you can see on the screen, it will get you to VTI. So that takes your 97 options down to 1. That's a great starting point. So the first thing you want to do within your account is add a new bank account so that you can actually purchase the ETF itself. So you want to go to more account information, and you want to click add a new bank. Now, the second thing you want to do is click on transact within your account and click trade Vanguard ETFs and non-Vanguard ETFs. So the first thing you're going to see is the symbol. Now, if we're searching for VTI, we can click VTI and we can click buy. The second thing we want to do is dollar amount, because we don't want to do shares because that's kind of irrelevant and we can buy fractionally. So decide how much in dollar amount you want to transfer into this account specifically. Let's just say it's $1,000. And then you can get the market order below. And that says dollar-based trades are only available as market orders. And you can see the full picture right here with the preview order. And when you click preview order, the next step is just summarizing all of this and then actually clicking purchase. The next thing you want to do is go into your automatic investments. Now, at the top of Vanguard screen, you'll see a button that says automatic investments. I want you to click that. And that's going to take you to the page that you need to set up 2 specific things. So the first thing you want to do is set up an automation that goes from your bank account to your settlement fund. And the second thing you want to do is set up an investment that goes from your settlement fund to the specific ETF that you purchase. So there'll be 2. Now, the first automation should be 2 days before the next automation so that you have the money in your account to actually purchase the ETF. And that will be on a recurring basis depending on what you decide that to be. It can be weekly, it can be bi-weekly, or it can be monthly. The larger the dollar amount on a monthly basis that you're contributing, the more incremental the purchases should be. If it's only $500, I would probably do it on a monthly basis. If it's $10,000 a month, I would probably break that up in 4 weeks to be $2,500 a week. So a simple 3 ETF portfolio that you could start with would be 60% VTI, 30% VXUS, which is an international fund, and 10% BND. That is a very, very simplified portfolio for anybody starting. That's not to say that makes sense for you, and this is not financial advice, but it's to give you an idea of how you could start. So you know exactly what an ETF is, you know why an ETF is better than the alternative options, and you know how to set up and buy an ETF and set up automatic recurring buys. You cannot be stopped once this starts. So the next step is to actually go into the brokerage right now and begin that account so that you can buy the ETF within your specific account. Like I said, a Roth IRA is a great start, or even a taxable brokerage could be another alternative. And if you want to learn how to actually build a portfolio that's suitable to you, make sure you subscribe to see what's coming next week. And comment the word ETF if you're ready to start below. I will see you next week.